Hi, I'm Carolyn Vernon. I'm the manager at Barthelin Thompson Remuera, and I'm here today with Hilary Johnson from Luminate, who is a mortgage broker that we highly recommend. And Hilary's here to talk to us today about what's actually happening in the world of finance and how it's affecting our buyers and our vendors and just generally people in the public. There's been a lot of changing in the lending rules. Can you talk to us about what's actually happening? We hear so much in the media and we hear all these other stories, but what's the real story that you're experiencing?
Well, thank you for having me along today because we are at a really interesting time in the market, and you're right, there's a lot of things going on. In fact, I would say we are looking at the perfect storm at the moment in terms of things changing that is making borrowing more difficult. Three things in particular that we're seeing in the market that are making the whole borrowing scenario more challenging for consumers is that there are rules and regulations being imposed on the banks from outside. So these are factors that are not from within bank policy, they're actually coming from the Reserve Bank and the law in one instance. So perhaps if I talk about three of those. So the first one is a change that was made on the 1st of November last year, November 2021. So the Reserve Bank amended the loan to value ratio rules. And simply what that means is that the Reserve Bank historically had said to banks that they could only have a certain portion of their loan book with low deposits, say 20%. When we got to the change on the 1st of November 2021, the Reserve Bank halved that portion. So it meant that a bank who used to have 20% of their lending with low deposits now could only have 10%. So what that effectively did was the banks shut the doors on borrowers with low deposits.
We've had that before though, haven't we? A few years ago. And they were thinking it would make an impact, but it didn't. And I think a lot of us went into thinking, oh, they won't make much of an impact again. But we got hit with another rule change.
Yes. So the rule change shouldn't last forever. In fact, we're seeing one of the banks has eased that loan to value rule change, but each bank has to stay within the Reserve Bank limit. So as each bank gets close to that limit, they shut their book. So you will see this come and go. This will continue to come and go as we go forward. So that's the first major change that impacted borrowing. The second change came only a month later. So on the 1st of December 2021, the next change that came out was a change to a piece of law, a piece of legislation called the CCCFA. So that is the Credit Contracts and Consumer Finance Act.
Very good,
Hilary. Piece of law.
All these acronyms, I tell you.
Boy, you get your tongue around that one. We shall just refer to it as the CCCFA from here on in. That was amended, and the essence of that law is to protect the borrower. So it's a good law, it protects the borrower, but unfortunately the tweaks that were made in December last year had consequences that they didn't necessarily realise to the whole lending industry, and that has meant that people who would have been approved prior to the tweak were no longer approved afterwards. And ASB are telling us that that's probably around 7% of the applicants who would have been approved after the tweak to the law were no longer
and we definitely felt the impact on the 1st of December.
So that's two things from externally from bank policy that has changed the borrowing landscape. So that was the changes to the loan to value ratio, changes to the CCCFA, and then the third one that is hovering in the background but is affecting borrowing is DTIs, debt to income ratios. So that basically means if I earn $100,000, it is possible that the Reserve Bank is going to say in the future you can only borrow $600,000. So the Reserve Bank is looking at this debt to income ratio. Now, two of the banks have already jumped the gun and they have implemented it already. So with those two banks, if your income is $100,000, you can only borrow $600,000. No matter if you can service more, no matter if you can demonstrate that you are able to carry more debt, that is a definite. So we are watching to see if that's going to come into play as a Reserve Bank rule. So those three things have really affected credit and the flow of credit and people's ability to borrow, never mind that we haven't even talked yet about increasing interest rates, about high inflation. You know, we're talking about 30-year highs in inflation, and we haven't even mentioned COVID yet. So it really is the perfect storm of a difficult time to be able to borrow money.
It is indeed. We hear again about these stories about the banks are looking at how much coffee you drink, how many takeaways you have, how many times you go and get your nails done.
Yeah.
Is that true? Is that what's really holding people back from getting their finance? Can you talk to us about that?
So certainly that discretionary spending is now coming into an application for lending more than it ever had in the past. So probably a good way to look at it is, in the past, before they tweaked the CCCFA, the banks always knew there was discretionary lending. They knew you needed X amount to pay your mortgage, X amount for your petrol, X amount for your insurances, and then most of us have a pot of discretionary income. And the majority of us, when we have that discretionary income, we spend it.
Yes.
So we go out, we buy coffees, we go to the movies, we have takeaways.
And like you and I, we get a nails done.
Absolutely. However, most of us, if we went and borrowed money and therefore we had more commitment to debt, we would naturally pull back on that. And the banks used to accept that. So before the change, the banks could take a reasonable, logical approach to say, look, we realise that these people have been spending at large because they had no commitment in terms of the mortgage and the rates and insurance. But as soon as they get this mortgage, they clearly have enough income. They will pull back on their discretionary spending and they will be able to afford this going forward. And to me, that was a very logical way to approach it, because I always think to myself, if we had a whole lot of people out there who borrowed way more than they could afford and didn't stop their coffees and their takeaways and carried on living like that with a large mortgage, we would see an increase in mortgagee sales. Surely. That would tell us that there was a whole lot of lending out there that was irresponsible. Well, that wasn't happening, and I don't believe that we've been seeing that. So this is a very, I want to say, draconian rule in terms of the powers that be forcing the lenders, because the lenders are terrified they'll get audited. You know, forcing the lender to say, we looked at every line in your bank statement and we can reasonably say you can afford the mortgage, and we took into consideration every single thing you spend. So yeah, it's making things difficult. It's making things a whole lot harder to get approved, and it's taking a lot more time, slowing everything down.
Okay, so Hilary, you would see an awful lot. You deal with a lot of banks, a lot of second tier lenders, a lot of financial institutions. So how do we help, I suppose in the first instance, let's talk about first time buyers. How do we help them to get them over the line to actually get a loan so they can actually live their dream of actually having their own home? How do we help that?
We are particularly worried about the first home buyers. There's a lot of rhetoric out there from the government about assisting first home buyers to get into homes, but all we see are changes being enforced upon lenders that are disadvantaging, in particular, the first home buyers. So I guess the rules are the rules, and we have to operate within those rules. So it's to try and think of ways that we can assist them within the parameters of the rules. So there are a couple of things that I would say. Save. Save like your life depends upon it. It's only usually a short period of time to be saving your deposit. It's not forever. Cut out the coffees, cut out the takeaways.
So that is true.
It helps. It certainly helps. One, because that money's going to saving, that can go towards your deposit. And two, it shows the bank that you are using your money responsibly. So that's a double whammy on the good side to save. In that saving arena, I would say, take out KiwiSaver. The minute a young person starts saving, we really encourage them to get into KiwiSaver, because that's going to be hugely helpful when you come to buying your first home, and it's savings that you can't get your hands on. So it's a really great way to help young people get into a property. So save hard, KiwiSaver, pull your savings in 3 to 6 months prior to you applying for a loan. We really want your bank statements to be showing that you are spending responsibly. Yeah. So if you came to somebody like me and I could see that this was going to be an issue with a lender, one of the first bits of advice I would say is, right, we're getting on a budget for 6 months. We're going to tweak this. We're going to shine you up so that when we get to the application process, we have got a very strong chance of getting it approved. So save. I hate to say it, but one of the biggest solutions for the first home buyer is the Bank of Mum and Dad. We love the Bank of Mum and Dad. Thank goodness for the Bank of Mum and Dad. So the Bank of Mum and Dad has saved many a first home buyer, and that intergenerational assistance is huge. And we love that that is part of the Kiwi psyche, that Mum and Dad are there to help. But the other thing is, and not everybody's got that. Not everybody's got that support. But one other thing that I think first home buyers should think about is pool your resources. So I've just done a loan application for 2 brothers and a sister. So 2 brothers and a sister pooled their resources. They're all going to live in the house together. So we combined 3 incomes, we combined 3 deposits. All of a sudden we would cross the line in a way that none of them individually could have done. So that's a really good idea for first home buyers to explore. So that's the do. The don'ts: don't go and take on debt. Short-term consumer debt damages your chances of getting a mortgage. So hire purchase, credit cards, car loans, lay-by, buy now, pay later, that's all very damaging to your mortgage application.
So the other group of people that are actually greatly affected at the moment too are existing homeowners with a huge amount of equity and probably a reasonable amount of savings. How can they go and get a loan easily? Because I'm hearing stories that that's not the case.
It's a challenge. It's a challenge. Perhaps I can take a step back and say we need to remember that the banks are predominantly cash flow lenders. Yes, they take security. Yes, equity and deposit is very important. But number one, you have to be able to demonstrate your ability to afford the debt and to afford the debt over the term of the loan. So if you are 55 years old and you're wanting to take on a 30-year mortgage term, the bank is going to say, well, hang on, in 30 years you're going to be 85. The chances are you won't be working, so your income stream will be gone. How are you going to pay the mortgage? And that all is wrapped up in their responsible lending practice. The banks have to lend responsibly. So it's a real catch for people who perhaps have really good equity, but maybe don't have a long runway left on their income. So there are ways around it. 2 very quick ways. One is exit strategy. If we lend you this money, how are we going to get the money back before you get to the point where you've got no income to be able to service it? And it may be that they have multiple securities, multiple investment properties. They may have a large KiwiSaver, and we can show, well, this client, when they get to 65, they will cash in their KiwiSaver, and that will be enough to pay back the debt. Now the lender's a lot more comfortable because they've got an exit strategy. So that's one thing, exit strategy. The second thing is that there are security lenders out there. There are lenders out there, they're not banks, but they will lend based on the security. So that's a whole nother side of lending, and borrowers really need to get good advice if they're going to go down that track.
Because I have heard there's quite a big uptake in second tier lending, which is we haven't had for a long time in New Zealand, but it's actually becoming quite commonplace. What are your thoughts about that?
Yeah. Thank goodness for second tier lending. Thank goodness for the non-bank lenders who are not necessarily restrained by the same rules that the banks are, because those non-bank lenders and second tier lenders have filled a huge gap. When we look at the quarter ending December 2020, how much lending was being done by the non-bank lenders compared to the quarter ended December 2021, huge rise, significant rise in the amount of lending that's now being done by non-bank lenders. And the great thing today compared to maybe 20 years ago is that a lot of the non-bank lenders are really good, reliable, responsible, well-backed, capitalized lenders. They're not loan sharks. They are responsible lenders. They just maybe are not restrained as much as the banks are. So we're seeing that part of the industry grow exponentially, and they really are filling a very needed gap.
It's really interesting. things change, that's for sure. So Hilary, would you recommend, if I was looking for a loan, that I would go straight to the bank or that I would go to a mortgage broker?
It's a good question, and the great thing in this country is that you have a choice. It's totally up to the borrower to make that decision. I have been a banker and I've been a mortgage advisor for the last 22 years. And I think if I can say some of the value that a mortgage advisor brings to the table is threefold. Number one, with all these changes going on in the industry, it has never been more important as to how you present your application for lending. So you can either go into a bank and have a go on your own, and that's totally fine, or you can get a professional who's been doing this for decades to package your loan application so you have the best chance to get it approved. And this is very interesting. It would take us, let's say, 4 hours to put together a really good loan application. Since the change in the CCCFA, that takes us closer to 5 hours now to get that application together, to get it right. So when it goes to the bank, we've met all the laws, we've answered all the questions, the borrower's chances of getting an approval are that much higher. In the last month, I've had 3 banks contact me to say thank you so much for the quality of your applications. It makes our life so much easier. And I say that not to impress you, but to impress upon people that it matters how you ask for money. So I would say a mortgage advisor could be a really good option in terms of giving you a professional to do that for you. The second thing is getting the best deal for you. So getting the best deal for you is all about a package. It's not just about an interest rate. In fact, I would caution people, the cheapest interest rate in the market may actually be dangerous.
Yes, I have heard that.
Yeah. So for people who go out there and all they're looking for is the cheapest interest rate, I would say be very careful. You could take a very cheap interest rate that maybe is the 1-year fixed rate today, and in 12 months' time, your commitment to your loan repayments may be double, and you could be in a whole world of trouble. So a professional mortgage advisor who knows what they're doing is going to look at the whole package. Yes, interest rates, of course, cash contributions, getting all sorts of things from the bank to thank you for your business and to assist you. But as important as loan structure, how are we structuring this loan? Recently we've helped a client by amending their loan structure. We saved them $68,000 over the life of the loan. Nothing to do with interest rate, because the structure of the loan was correct for their particular situation. And exit strategy. How are we going to get this debt paid before we're 65? So a mortgage advisor will put together the application properly. A good mortgage advisor will get the client a good package in terms of their mortgage, overall package. And thirdly, it doesn't cost anything. So there's no cost to use a residential mortgage advisor in New Zealand. So I guess my question is, why wouldn't you? Why wouldn't you go and
Great to deal with one person.
Some good advice. It is lovely to deal with one person when banks can tend to have a high staff turnover. So it is nice to have one person who stays with you for the term of your loan, who knows your situation, and can go through that with you as time goes by.
Well, thank you, Hilary. It's been fantastic. You've been so informative. Amazing use of acronyms, I have to say.
Thank you.
But more importantly, some really great advice. I know who I'd be going to and who I do go to, and that's Hilary Johnson from Luminate. So really appreciate your time.
You're most welcome. Thank you for having me.
You're welcome.